So the Federal Reserve has some early Christmas gifts for us here, at least short term. And as you see, my curtains are up, the Christmas tree is already in. So at least here in Sweden, I'm gearing up for Christmas. And what I want from Federal Reserve is some news regarding the interest rates, and we got it today. They decreased their rates by 0.25%, and that was in line with expectations. So that was something. You call it a little gift, making it giving us the news we were hoping for going into Christmas. I don't think it will affect the marketplace, at least short term, regarding stock prices, etc., because the expectations were already priced in that they were going to cut the rates here. I think 9 out of 10 bureaus was expecting this, so nothing nothing new there. Even though I guess long term it's just proves that the Federal Reserve see that the marketplace now is in a stable place and the inflation is more stable, and that they long term now expect or want to give the marketplace a boost. And later in today in this video, I will show you Jerome Powell speaking about the decision, and also about his legacy a bit. But the big gift or Christmas gift from Federal Reserve is not talked about as much. But as you have seen in the market, there's been more people has talking about liquidity crisis, that there are not as much liquidity going around anymore as it was. It has sort of dried up, and the situation for a lot of banks has getting tighter. And I want to today take a look at why this is, and actually provide you with some insights about what Federal Reserve are going to do about this situation, or what they are going to do will affect that situation, which will actually be very useful for a lot of us. So what you see here is the recent balance sheet trend of the Federal Reserve, their total asset under management in millions of dollars. So obviously, to make it easier here, this is $3 trillion under management, or in the balance sheet. And here we have $4 trillion, and at the peak here around 2022 we have $9 trillion. So the increase in terms of the balance sheet of the Federal Reserve has been very big. I don't want to put my own belief in whether or not this is good or bad. Obviously, they had the reason to do this because nobody did know what was going to happen during the pandemic when everything was shut down. So it was sort of a panic mode in the world at the moment, in the USA, in the biggest economy in the world. So they just pushed the money printer and bought so many bonds, treasuries, etc. So they pushed that balance sheet up to $9 trillion. And yeah, since 2022, they have actually decreased the balance sheet here down to $6.5 trillion. So that's quite a massive decrease. That's called quantitative tightening. So what they do here, when the graphs are going up here, when they are expanding the balance sheet, that's the quantitative QE, quantitative easing, and now it's the QT, the quantitative tightening. But we have a problem, because where we are now, we're seeing the job market being quite slow. We have had a quite sticky inflation, but it's getting a bit better. At least if you listen to what the Federal Reserve are saying, they are saying that despite the inflation not being down 2% yet, they feel like there are some short-term things that are pushing up the inflation over 3%. For example, tariffs, etc., and some laggings in the numbers. But they feel like in 2 years we are probably down at 2%. So they feel quite confident that they can, for example, cut the interest rate by 0.25%, but also provide us with an early Christmas gift. And that is, they're going to end the QT, the quantitative tightening, it's ending here. From the 1st of December, Federal Reserve decided that we we need to be more stable in our approach regarding uh, the balance sheet and the liquidity going forward. So you're gonna stop tightening and be more sideways here in terms of upholding the strength of the balance sheet. So it's still very high levels compared to historically. So I think it would be healthy to push it down more when we can. But maybe if you have followed financial news and macro news lately, you've heard about the liquidity drying up, and that is not a good thing if you want to expand, if you want to invest in infrastructure, etc. In as USA want to do at the moment in AI, want to be the forerunner in innovation, etc. Then you need cheap liquidity out there, and that is what Federal Reserve are going to provide now when they feel that the inflation is a bit lower. So, what does that mean for us all? That probably means that more liquidity most often means that the stock market is going to be performing quite good also. So that is basically my thesis around this early Christmas gift. This will bring a lot of confidence going into the marketplace. I feel, at least short term, and I do not think it's fully priced in. A short analysis here before we continue listening to Jerome Powell, the chairman of the Federal Reserve. The marketplace has actually performed quite good since 2022, despite the quantitative tightening here. And why is that possible? Well, they have had something called RRP. That's a reserve that the Federal Reserve has had in the balance sheet that has provided liquid funds for the market. But that RRP is now dried up, so they don't have that sort of revolver of cash anymore for banks, etc. So they are sort of in a quite tight situation, and to really meet, just to provide you with some more color to what's going on when the Federal Reserve are tightening or easing the balance sheet. So basically, you have the assets. Usually, it's like treasuries or mortgage-backed securities, etc. Liabilities, bank reserves. Yeah. And when the Federal Reserve buys securities, that is called QE, quantitative easing, and when they do this, it basically creates liquidity. And when the Federal Reserve then sells the securities or lets them mature, and they don't reinvest, that is what's called quantitative tightening, QT. And this is what drains the reserves and reduces the liquidity in the marketplace. And this is what we have seen since 2022. The strange thing is that the marketplace, despite that, has performed quite good. And this is because they have something called RRP, an extra fund of $2 trillion that has still pumped out liquidity to the marketplace, but that is also dried out, and that is why basically they now have to bring us this Christmas gift in terms of ending the era of quantitative tightening. And yeah, we have seen historically that this balance sheet tends to expand more because the economy as a whole is increasing rather than shrinking. So it's hard for them to, when they have expanded so much, to just keep on tightening it, especially when the marketplace just screams for investment and for cheap liquidity, etc. So in a way, it's good for everyone here to know that that is happening, and it makes it easier to understand the macro trends when you are investing. So this is the Federal Chair, Jerome Powell, delivers his remarks today after cutting the rates by 0.25%, talking about inflation and why he do not think it is as high as many of the journalists out there speaking to him. He's talking about that maybe they are actually quite close to the goal of 2%, but what is pushing the inflation up is some temporary effects, like, for example, the tariffs, and that long term he feels like they are closing in on the goal of 2% inflation, why they feel quite confident in decreasing the interest rates, which will make it easier for companies, etc., to borrow money and maybe be a long-term boost for investment in the economy as a whole. So it's kind of a bullish sign, but obviously sometimes the marketplace has already priced in um, these type of decisions from the Federal Reserve. So just because the decision is being taken today, probably the marketplace has already positioned themselves a couple of days before uh, the decision is taken. So that is why we, at least at the moment when they told us about the cut, I did not see any increase in stock prices, at least in my portfolio. But we will see maybe later today or tomorrow what will happen. Anyway, let's listen to Fed Chair Powell here, and he will also get a question about his legacy, and I think it's fruitful to listen to him to understand where they are coming from when they are taking these policy decisions, etc.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what and it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy. But we've moved back our policy back down to where it's not. It's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
So I have some closing remarks here after listening to the chairman Jerome Powell um, regarding the economy of USA and other countries as well. There is no magic pill. Every country has problems. especially since the pandemic. There has been a lot of money printing around the world with high inflation. We have had a couple of conflicts in the world that has increased the money printing and create some problems regarding specific areas of the economy that it gets affected, for example, food, etc. So he's saying that he still believes that they have performed really good at the Federal Reserve, and that USA is actually the country that has performed the best uh, the latest couple of years, with a strong economy, the inflation getting more and more under control. The growth is a lot better than in other countries, etc. So he was basically saying they are doing, despite everything that's going on, a great job. They can't solve every problem out there. They are focusing on what they can do. For example, decreasing the interest rates so it gets cheaper to borrow, and that can stimulate the economy and grow the economy even more. But obviously, they can't decrease the interest rate if the inflation is too hot. So the most important decision they are making at this moment is actually having that long-term view, because a lot of us feels like maybe that the economy is too hot at the moment, the inflation is too sticky and too high. But what Federal Reserve here are saying is that it's actually a short term that the inflation is over 3%. It's based on tariffs, etc. But in the long term, we are actually getting very close to our goal of 2% inflation. And that is why they feel so confident in decreasing the rates by 0.25%, providing that little boost to the economy. And he did not talk about the quantitative easing, but I, doing my research, know that that is also happening at the same time as this 0.25 decrease in interest rate, and that is providing a good foundation going into 2026 as an investor. And that is what I feel is like an early Christmas gift in this. That is everything I can demand from Federal Reserve at this moment. They could have just have the interest rate stay stabilized. They could have continued to tightening the economy a bit, but they didn't. So hopefully they are doing the correct decision, short term and long term. Obviously, this is very good short term, but if they are actually uh, doing the easing of the liquidity too early, we can have the inflation getting even more sticky. I guess more healthy levels would be to push long term the balance sheet back down to 4 trillion at least. But we will see when they can do that, because we know that the United States of America is going through massive investments, both from companies at the moment and also from government. They're gonna have to invest in energy, in nuclear power, in the grid of energy grid, etc. Companies are going to invest also. So there will be a lot of demand for liquidity out there. So I feel like they are setting up the stage for 2026. And yeah, we can just we do not decide here. We just need to understand what's going on, and we should have the same type of information as the hedge funds out there. So we can't let them have that information advantage towards us. So that is why I want to provide you with this type of content, and hopefully it's helpful for you when you navigate the marketplace. You always have to do your own due diligence, and it's always your own risk when you invest in stocks or funds or whatever you want to do. But still, I'm just want to say that it's healthy to have a bit of a knowledge and just not invest by chance out there. By knowing more, it increases your way of understanding the marketplace and what's going on. Anyway, thank you for tuning in. If you enjoy this type of content, don't forget to subscribe. And yeah, you can try to like the videos if you want. Also, people don't do that as much anymore, but it still gives some type of boost signal to the algorithm in the YouTube. And you should remember my username WFinance&Stocks, because if you just subscribe, it could be that you already subscribed to 100 other YouTube channels. You will never see me anyway. But if you actually search for me a couple of times and revisit me. I will post videos every week. Then you will get recommended to me more often. And obviously, that's good for me. But if you enjoy my content and feel like I'm quite objective and truthful in my way of approaching things, that could be good for you also. So yeah, that's what I wanted to say today, and I'm glad that you tuned in, and hopefully this was useful information for you. Bye.